What we can get is bifurcation. We can get different parts of the market acting very differently. I do think it's going to be very hard for high PE tech stocks to do really well in the kind of market that you and Mike and Wilf are talking about, which is going to be rising rates and a strong economy. In that kind of economy, the reopening names, the value names, the energy names, the banks that are trading at very reasonable valuations can do well. I think it is still going to be hard for these no earnings companies trading at huge valuations to do well in that environment.
To what extent, though, Charlie, have some of those inflation plays also got exposed to any risk? If we do see another big leg lower, does everything go down? And have you kind of raised your cash balance, for example, higher than it has been at any point of the last 6 or 12 months? Or are there plenty of buying opportunities out there?
No, plenty of buying opportunities. By the way, Wilf, I'm wearing my Winston Churchill tie in your honor, and we are so sorry to see you going back to that blessed plot. But no, the answer is that the inflation names, my Apache and Mosaic, are trading at 6 times earnings, and those earnings forecasts are going to go up with inflation, not down. People were not anticipating $95 oil for Apache. People have not been anticipating $6 corn for Mosaic. We are going to have very strong environments for inflationary stocks, put another way, stocks that do well in an inflationary environment, because the market has been thinking that this was going to be an inflationary transitory process. And I happen to not think, as you know, that it's going to be with us for a lot more than a couple months.
Let's hit oil prices, because that is certainly fueling the inflation story. Energy, though, the worst performing sector on Wall Street today, despite the pop in oil prices. CNBC.com's Pippa Stevens here to break down the sector's biggest losers. And Pippa, what you're hearing about the divergence today.
Hey, Sarah, that's exactly right. The sector is down more than 2% despite a jump in oil prices, which pushed WTI above 95 and Brent above 96. Every component in the sector is in the red, led to the downside by APA, which is off by about 6%. Fellow drillers Marathon Oil, Occidental, Diamondback Energy, and Pioneer also moving lower. So what's behind the disconnect, and why aren't energy prices following oil higher? Well, Eric Whiteman from XLM Financial Group pointed to the latest rig count data, which showed U.S. drillers adding the most in 4 years. He said this is prompting fears that companies could increase production at the expense of higher capital returns. Also could be some locking in of gains with names like Devon and Marathon Oil more than doubling in the last year. Guys, back to you.
Pippa Stevens. Pippa, thank you. Charlie's already such a big move for oil. This year, last year, more to go? And if so, how to play it?
These stocks, if you look at long-term charts, these stocks are still way, way down. And this has become an uninvestable asset class for many people. Obviously, the ESG pressures have taken money out of the space. And so we have now got names that are being priced on a $55, $60 barrel of oil. If we get prices at 70, 75, the companies are going to make a lot of cash flow, and they are committed to returning a big portion of that cash flow to investors. Yes, there'll be incremental capital expenditures, but these are going to be very good return to shareholder stories.